Hello and welcome. You're watching Business Today Television. I'm Salshi Batra and this is Market Today, a show where we'll help you understand the closing action on the D Street. Well, now about a 50 points lower in trade, 25,474. We have slipped below that 25,000 mark that we were holding on to, 25,500 mark that we were holding on to for some part of the day. And there is a lot of choppiness that continues on the street at this point in time as well. What is in fact getting into trouble? You can see the real estate, metals, oil and gas, IT, these are the pockets that are down in trade. The Nifty is lower. You can actually see some of the stocks that are down within the Nifty pack. Well, that should give you some sense of which are the top spaces which are down. You have HCL Tech, you have Reliance, you have Hindalco, Tata Steel, Tech Mahindra, all of these stocks which are lower in trade. So IT is losing ground. Remember, tomorrow onwards we start to see the Q1 earnings of these companies. Market is turning defensive. You can clearly see from the FMCG moves that we've been looking at for the last couple of sessions. Pharma is holding up in gains. You have consumer durables, autos and financial services that have gained a little bit on the stock markets today, but there is an overall weakness that we still see on the index level. Let's get Mr. Sharad Avasthi with us on the program to help us understand a little deeper when it comes to the market moves and of course what to expect going forward from here. Warm welcome to you, sir, and thank you so much for taking the time out. There's a lot of aspects that we need to discuss with you, but let me actually kickstart by understanding about the Jane Street issue, sir. As to how are you looking at it, because this has probably opened a can of worms and probably given us an understanding that the small retail investors, no matter how much has SEBI tried to protect them, taken so many measures, will continues to stay vulnerable to at the hands of such large quant-based, large machine-based trades being taken by the hedge funds like Jane Street. Now, Jane Street continues to say that SEBI order is fundamentally mistaken. They are not able to understand that it's a strategy in the making. There is nothing manipulative about it. But SEBI, on the other hand, has clearly talked about in their 105-page order how they have found malicious intent behind the large orders that they have taken in. How the whistleblower Mayank Bansal, who was with us for an hour today to detail for us how the modus operandi worked, and he did point out that for such players to be holding our flagship indices like Nifty and Nifty Bank as hostage is something that really raises a lot of alarms that we have to be watchful of. How have you read through this entire saga of Jane Street, and what is the top learning for a market participant, sir?
Uh, yes, Sakshi, thank you for having me on the show. I think the major learning is, that anyone with a technological edge or capital edge will always, if they have the will to manipulate, they can manipulate. The larger masses are more, susceptible to this kind of manipulation. That's always been the case. Fast money attracts a lot of, bees and butterflies to the party. So I think that is one problem, that greed and fear are primary emotions which run the equity market. So I think that will continue for some time. But regarding this, I think what the regulator can do, I think the moment that what we can see is maybe you have to put some curb on sizes, etc., in terms of the quantum of deals individuals can take or entities can take as groups. So I think that would be for the first curve that they might be looking at. And generally, I'm not a very big fan of options, etc. So I think they were primarily brought in to hedge, but they end up being speculative things only. And this time around, I think they have moved or preempted a bit earlier, because generally we are in the habit that when a scam reaches, or a problem or a manipulation reaches a stage where we can't really manage it and it blows out of proportion, it is then when we usually wake up. So, in spite of the fact that we took around a year after the whole hand-holding process started, but I think, yeah, it's better that they woke up earlier, they put in some checks and balances, and they work continuously, alerting the general public about a problem that this could cause. The options trades are much higher vis-a-vis global averages. Though many people used to call it an aberration, that maybe you're being too cautious. But I think being too cautious is better than failing much later when there's too much out of control. So I think, yeah, in some ways the regulator has done a good job by curbing some of the excess volatility in options trading in a timely manner, and understanding that the trend that was developing in India vis-a-vis the global trend was particularly indicating to something that is speculative. Regarding the legality of it, whether how much of it SEBI can probe into and tell them that it was unlawful or something, I think there is some tax angle which is probably against them on the trade side. But other than that, if you are not really putting a curb into the type of sizes that people can trade on, uh, when you are talking about a free market, I think it's very difficult to challenge someone's position betting. I mean, there are no rules which tell you that you can't bet beyond a certain point, right? So if you're not putting that rule in place, everyone's free to do that. What other rules they can put in or pull in, to bring them to the table, or what other findings they get, that is a call that SEBI needs to take. But I think this has been a timely intervention by the regulator. That is why maybe a lot of people may have been saved, and thankfully it has not blown out of proportion. Certainly problematic that the frontline indices can be manipulated in this fashion. I think the ideal thing would be to limit trade sizes. I think from the institution side, there are some limits on what volumes you can trade as a percentage of the total. So some similar mechanism even SEBI can adopt maybe on the option side of it. And I think too much speculation was happening now. Gradually, what would happen is, that some people would have adopted to a system of understanding the trading psychology out of options, etc. Now that will need to change. So maybe for some time you will see lower volumes, etc. Regarding what the regulator can do, I think that's what they need to do, put some position limits, etc. But I think they are better equipped than me to understand what to do. But certainly a timely move, good, and in case they have done something wrong, which is beyond the legality of it, they should certainly be brought to court.
Okay, got that. So that's the viewpoint as far as Jane Street issue is concerned. And viewers, we have highlighted for you that this is just an interim order. Remember, this will be developing going forward as well, and we will definitely cover each and every aspect that you should know about such an issue. We have seen this swift downtick in the markets today. This was right after the news flow came in that there is. A Hindenburg like short seller that has now blamed Vedanta and Hindustan Zinc. Both these stocks have actually fallen. This short seller Viceroy has called the parent structure of Vedanta as a Ponzi like scheme, and therefore we have actually seen a sharp downtick on both these stocks. They have recovered from those low points. This is after Vedanta has also come up with a statement refuting these allegations as well. But at the same time, this is Viceroy Research that has accused Anil Agarwal's Vedanta Group being a Ponzi scheme, which has triggered this crash. It has allegated that Vedanta Resources, the parent company, is draining cash from Vedanta Limited through disproportionate dividends and debt, pushing the group towards insolvency. Let's try and understand, sir. How would you really look at this first instance of a news flow that's coming in from Viceroy Research? Short seller, first it was Hindenburg that came down heavily on Adani Group, talking about financial disproportions and misappropriate work that was being done. Now it's Vedanta on the radar.
Uh, I don't think contra views are welcome. Maybe they feel that way. But to malign someone's image without having proper proof, even if you looked at the Hindenburg report, I think it was not very substantive in what they did. But yeah, they did help in bringing the abnormal valuations within the Adani group to a normalized level. So I think it's good if you are a long-term investor, you would get opportunities. Regarding corporate governance in the issue in the group, I think that is a well-known factor that there have been issues here and there. But I think gradually they are trying to put the house in place. And regarding paying dividends and borrowings, etc., I think these are all well-known factors. It is not something new you are bringing to the table. Everyone knows the modus operandi that is being followed. So I don't think you should be reading too much into it. Knee-jerk reactions here and there. I think both stocks are valued fairly squarely. So maybe, and the metal space also with the dollar index gradually coming up, moving up. I think the hype and hoopla around metals has substantially eased over the last 5-7 days. So I think all this has resulted in this. So not much to read into.
Okay, so that's as far as this fresh and new information that has impacted the sentiment on Vedanta and Hindustan Zinc. Both the stocks had slipped up to 8% in the intraday trade right after the news flow, and we have now seen some recovery come in. This is after Vedanta has called it baseless, and therefore you do see some improvement on that account. This definitely will need some of more of our attention, and we will detail for you in a separate video as to what have been the allegations made, and of course what should you be really understanding on the same as well. Mr. Avasthi, let's come to the global picture now. Today is July 9. This was supposed to be the date when all reciprocal tariffs should have been coming into effect. India still does not have a deal done yet. Neither has India attracted any letters from US government, which they have sent across to 14 nations talking about the higher tariffs which now come into effect on August 1st. Now, as of yesterday, we have seen that Donald Trump has also talked about a 200% tariff on pharma. He's talked about a 50% tariff on copper, an additional 10% tariff on all BRICS nations as well. So the tariff saga, which we were hoping that will be done and dusted by today, does not seem to see any end as of now. What's your fresh take, sir?
Yeah, I think that it will continue for some time. I mean, we might have extended it by a month, so we will have more to look at Twitter X for more developments from Trump. Uh, but largely, when I look at the picture, I think while some pockets might get impacted on the international scale, now they're also talking about probable inflationary impact on the numbers in US, etc. That might delay the rate cycle movement. So maybe your downward rate cycle goes down by around 2 to 3 months. So that is one thing that I'm expecting. And regarding tariffs, I think on the India side, while we are rejoicing, but while we're rejoicing, we were rejoicing textiles yesterday most probably. But I think with Trump, unless and until something is sealed and done, to rejoice too early would be a problematic thing to do. Trading is fine, but for investors to take a call in this kind of scenario would be very difficult. Though I still believe, that the India side of the deal will be favorable for us, and I think again the problem has been, as we were expecting earlier, dairy and agri products that remain, a cause of concern because India is not going to budge there, and America is also trying to stick strong with it. So I think maybe another month of uncertainty we are looking at based on this. We have largely been range bound for quite some time now, and I think after a 10-15% kind of rally, it's normal. So maybe some more range bound volatile movements of another 10-15 days till more clarity emerges on that. But largely, whatever it is merged, I think once a EU deal happens, some deals with India happens, largely our markets will take solace from it and gradually start going up. So maybe another 7-10 days of more volatility. That's at max that we are looking at, and after that we'll start getting more clarity. Regarding the 200% pharma tariff, I think again that would largely be concentrated on the branded products. Where I think in our case, domestic company Sun Pharma gets hit the most. Though it's not still very material, so I don't think you are looking at a very stark reaction. But maybe it's all talking down, and if you are shifting bases there, that should not be a problem. Something here and there, it will work out in between. So most of these rates are more, talking through the high points that we will do this, do that, but most probably it will settle at much lower rates. So to sum it up in the actionable terms, I think what you have is maybe another 10-15 days of range bound markets. Uh, but after that, we should resume the uptrend. That's what I think is most probably going out. And for pharma, I think barring Sun Pharma, most of the Indian companies are generic, so I don't think there would be much of an impact.
Okay, there won't be much of an impact right now. Do you expect any texture, tenor of the kind of mini deal or a deal that could come India's way at this point in time from the likes of the deals that have already been signed? Should we take any signs that what could be coming in our way, especially if we also look at what has happened with the 14 other nations that have been, receiving letters of higher tariffs coming in, not very different from the April 2nd commentary or the first announced tariffs that they were talking about, US was talking about. So, looking at all of this, what can India really expect for itself?
I think largely whatever you are hearing from the US counterparts and even from the Indian side of the story, it seems to suggest, that most probably we will have something very favorable vis-a-vis what we have seen with the rest of the countries. So I'm expecting a very favorable kind of outcome for India. Maybe that would surprise markets positively on the upside. But it's very difficult to call a timeline as to when this will happen. But I'm hoping that over the next 10, 15 days, you will have a much more likely, much more concrete announcements. Maybe, as you rightly pointed out, a mini deal kind of structure points out, and rest of it is left to, licensing beyond that. That is a possibility that you could look at. But largely on balance, I think even if you talk about a mini deal or any kind of deal or announcement, largely what I'm expecting is that India probably would have a better deal vis-a-vis most other countries, and that gives you a competitive advantage. Then beyond that, the focus will shift, that how post tariffs the US economy is going to, shape up, how inflation is going to shape up, what it will do to the trajectory of, uh, rates globally and US as well, because India to cut rates standalone without US cutting rates from here, I think is a difficult possibility.
Okay. Another key trigger is what we started off our conversation with in this morning that, of course, tomorrow onwards we start to see the Q1 earnings. It will be TCS first, and of course, the rest of the IT pack that follows. We'll take this question in two ways. One is your outlook on the Q1 earnings for IT space as a whole. What's your large expectation there? And, we had seen after Q4, some of the stocks did come up. Do you think Q1 can actually further those moves as well for the IT pack as a whole? And any outperformance that you see within the IT pack also, where could that come in from?
See, in terms of quarterly numbers, Sakshi, I think this quarter, most probably the future outlook will be much less clouded vis-a-vis what it was last quarter, because we were very high on the tariff uncertainty. This quarter around, we will have much less uncertainty around tariffs, though the uncertainties are still there because Trump keeps flip-flopping. So I think tariffs will cause some uncertainty, but the larger uncertain picture that was initially being painted, that's much more easier to handle now for most companies. So the forward outlook probably will be much more clearer. So maybe the results, don't give you a very high point in terms of expectation, but post-result commentary, I think, would be very positive from most IT companies, at least much better than what it was last quarter. That is one take. And regarding outperformance, I think, yeah, what Coforge is probably expected to post the best numbers in terms of growth, etc. Coforge persistent would be growing at much better growth rates. That's been the case. But when I look at valuations, I think the Sand probably looks like a very good stock offering a very good margin of safety. And within the IT space, if you want to, spread your horizon beyond the quarter, obviously, then it will make sense. Maybe this quarter, performance-wise, Coforge would be one of the best performing counters. And regarding long term, I think Sand probably is a good bet. You could look at valuation comfort is higher there. Similarly, there is one much smaller company, Orient Tech. I've been looking at it. I think largely domestic driven demand, and the second half probably would be much better for them. So that could be one more counter. If you're looking at a longer horizon, 9 to 12 months, you could look at. I think these two could be good stories to look at.
Okay, fair point. Now, beyond the IT sector, also, sir, are there any expectations from Q1 earnings for specific sectors that could turn out to be better than the others? And also, if you could highlight any underperformance, if one should also be prepared for in the upcoming earnings, sir.
I think BFSI, I've said earlier also that would continue to do well. There is one sector, there could be a turnaround. I think the footwear sector could be something that turns around, in this quarter or maybe next quarter. So maybe the commentary from that side improves much more over the years to come, over the quarters to come. And regarding the sector where I think there is a bit of problem, I think as we were rightly speaking about the Jane Street issue and the fallout and the options volume coming down, I think equity exchange related stocks as well as the broking stocks. That could be some space which could be in for some damp kind of environment over the next 1 or 2 quarters, where maybe the number of accounts added etc. do not culminate into the type of volume growth because of substitution of volume from the absence of these option trades that rebalance and reschedule themselves to the new format. So I think maybe the broking stock, company stocks and the index stocks, particularly BSE, etc., could be in for some tough time.
Okay, fair point. I hope this has also got a lot of understanding to our viewers. What about the broader market, sir? How are you approaching the mid and the small cap space afresh, Nifty 500 names afresh? Is it absolutely a stock specific strategy there, or is there a trend that one should be aware of?
What we are expecting is that the next 6 months we should see a strong rally, and usually strong rally should be broad based, and you have had underperformance from the mid cap, small caps over the last 6 7 months. So from here onwards, I think probably with that kind of large rally, a broad based rally, you could expect small cap, mid caps to outperform large caps over the next 6 to 7 months at least. That's the viewpoint we are taking now.
Okay, got that. Let me also talk about some of the other pockets. Consumption, sir, FMCG stocks have started to pull up a little bit. We are seeing HUL, Nestle, Dabur, Marico, all of these names also come back, ITC also. What's your fresh stance here, sir? Do you think this beaten down space is now getting ready for another leg up?
It certainly looks like that urban and rural consumption both coming back. We could have a leg up for these. But beaten down, well, I don't think it's an across the board beaten down kind of story in terms of valuation. The valuations went up a bit too high, so they have normalized now. While I would not call them, the likes of Britannia, Nestle, Lever as cheap, but yeah, maybe they are near to their long-term averages in terms of valuation. So you could start nibbling on them. But if I have to bet, I think something like an Imami we have been recommending. Something like a Dabur could be a good bet. It has not done anything largely. On the smaller side, something like a Jyoti could also be a very good bet. Jyoti Labs. I think these are few bets you could look at.
Okay, fair point. Let me also ask you on the auto pack, sir. What's your stance here? We saw Tata Motors business update. The wholesale sales have declined again. It's a slightly muted, number across the board. PVs, CVs, and even JLR. This has been one of the stocks which retail investors hold a plenty in their portfolios and therefore draws a lot of attention to. What's your fresh stance on Tata Motors and the overall auto space? How are you looking at it?
Generally, see across the board, I think the auto space should fare pretty well. I think with the tax cuts, with the pay commission improvements coming in, you would have additional money in the hands of buyers, so that should result in higher buying. We have seen a slow period over the last 3 4 months, but I think now that should change. The type of growth we expect in terms of capex, etc., and industrial activity post monsoon, even your PVs, etc., should go up. The type of electrical demands, for infrastructure, etc., and urbanization, etc. I think that space is should buzz with action in the long term, and even in the medium to short term. I think demand should be healthy. For Tata Motors, I think yeah. Uh, it's been a bit of a whiplash, primarily from the JLR side. The new launch has received a lot of whiplash, this, that. But I think when you reinvent, these things happen. I think when the final product comes out, that would when we would start in the next, 12 months, 12 to 18 months. I think it's going to be a very hyperactive space for JLR, for some of the Tata India launches as well in the passenger vehicle side. I think I'm looking at a very interesting time for Tata Motors. Obviously, in terms of numbers, JLR is the heavyweight, which is putting in most of the work and behind numbers. So I think a lot will depend on how the sentiment turns around JLR. But with China improving, the UK FTA done, US UK done, most probably tariff etc. will be behind us over the next 2 to 3 months. We will have much clearer pictures. The balance sheet is much better for JLR. And I think valuation comfort is highest for me within the auto pack in Tata Motors. So we continue to have the same view, targets 950, 1000, hold for around 1.5 years. That's what we are looking at. I think over the next 6 to 12 months, you could see a lot of action there.
Okay, fair point. I hope this has also got a lot of, concerns addressed around the auto space there. I want to also get an understanding on, sir, the new age tech space, especially the stocks that were so far big laggards. Nika, delivery, how are you looking at these stocks, sir? Slowly and gradually, these stocks are showing us some traction on the higher side. There is talk about some improvement. Business updates talk about, mid 20s kind of a growth on some of the aspects for Nika. Slow gradual improvement after a long haul of pretty much not doing anything on the street. How would you look at such stocks, sir?
Uh, So Nika, I think we are talking about EV to sales forward at around 6 times yet. I think it's moved, maybe 6.1, 6.2. So I don't think it's very stretched. Ideally, maybe in 1 year's time, it trades at 8 times EV to sales, considering it as a pure platform business. Once you see improvements, on the number side, so you could have around what 20-30% upside on Nika still from here, even on a conservative basis. And I think the earnings have seen expected earnings have seen a very large collapse over the last, 1.5, 2 years. And from here on, if they can pull, some strings back. And I'm very impressed with the second line of management also. I think they are also very hands-on with what they are doing and what they want to do. Some ventures here and there for these companies will go, out of the way and maybe derail them a bit. But I'm not reading too much into it. So at 6 times EV to sales, you expect it to trade at, maybe 7 to 8 times EV to sales. So you have decent upside from current levels, at least 20 to 30%. So I think Nika you should continue to hold. I don't think you should be very nervous about these valuations.
Not be very nervous about it. Okay, Mr. Avasthi, thank you so much. Appreciate your time with us and your insights on various pockets of the market that you've delivered. Always a pleasure to host you. We'll see you soon, sir. Thank you. All right, viewers, we'll start to wrap up the trade for today. 2 minutes to go, and tomorrow we will be heading into the weekly expiry. We started off on a slight back foot, and we are ending on the same space as well. 25,473, 50 points lower. So the green tick stayed for a little bit throughout the course of the session, but towards the end we've given up that as well. FMCG continues to hold up 0.7% higher, the top moving sector today, followed by consumer durables, autos, pharma, financial services. Downward momentum was dragged by real estate, 1.5% losses, metals, oil and gas, IT stocks all were the top losing sectoral indices. On the Nifty, Shriram Finance pulled up as the top spot today, Bajaj Finance, Coal India, and you also had names like Hindustan Unilever continuing to pull up. UltraTech Cement, Hero Moto, these were the other names that pulled up. On the downside, HCL Technologies, Hindalco, Tata Steel, Apollo Hospitals, these were the top stocks that dragged on the lower end as far as the markets are concerned on the Nifty. F&O space, look at PG Electroplast. Remember, this was the EMS play stock that Gaurang, had talked about in his morning commentary, that this is the stock that he bets big on. Today, it's the top mover, 6.5% higher. Nika, we've just discussed with Mr. Avasthi. RBL Bank also up within the F&O pack. On the lower end, Union Bank, after those Q1 business updates right from the morning trade, started to decline, now ending about 4% lower in the F&O space. Max Healthcare, Gale, these are these other stocks that have declined in trade. We have the final print on the Nifty, 25,464. Let's see how things pan out and whether tonight will be another night of waiting and finding out whether a deal with India has been signed or not. Today is the deadline that US had been talking about, 9th of July, by when they wanted whoever had to be signing a deal should be signing a deal or else pay the tariffs that were announced. 14 countries have been sent letters. India does not find a mention there, and Donald Trump has consistently marked that they are very close to cracking a deal with India. Let's see what kind of a deal comes in our way, and the markets seem to be waiting to get that. Tomorrow again will be the kickstarting of the Q1 earnings as well, so focus will be on the IT stocks too. Stay tuned. There's much more coming in for you on your screens on markets today, as well as business today television. We will have market master conversation with another top guest of ours at 4 p.m, so stay tuned for that too.
Submerged roads, damaged homes.